Shanghai is paying $250 more per ounce for physical silver than the COMEX paper price? Right now. Today. That premium is not closing, it is holding. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Gold closed Friday at $4,030 per investing.com. Silver closed at $81.18 per investing.com. Both metals, fourth consecutive weekly advance. That is not momentum trading. That is sustained institutional demand meeting a physical market under strain. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today, the Shanghai Gold Exchange. Gold intraday range Friday, $4,167 to $4,189 per investing.com. Silver intraday range, $77.80 to $83.06 per investing.com. A 5+ swing in silver within a single session. The SGE, the world's largest physical precious metals exchange, is pricing silver at approximately $82 to $83 per ounce in USD equivalent terms, per GoldSilver.ai and metalcharts.org. That is a 150 to 250 premium above COMEX spot. The unusual detail is not the premium itself. It is the persistence. Temporary arbitrage premiums normalize within 24 to 48 hours. This one has not. It has held across multiple months and multiple price levels. The timing is what deserves scrutiny. Not the number alone. The timing. Think about what that sequence actually means. A physical delivery exchange, where real bars change hands, is pricing silver higher than a futures exchange, where fewer than 1% of contracts result in actual delivery. That divergence does not resolve downward. It resolves upward. The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. SD Bullion has reported that COMEX registered silver inventories have dropped by roughly 1/3 since September 2025. 1/3. In 7 months. The last time registered COMEX silver declined this aggressively. Silver repriced by more than 50% within the following year. The data is already telling you something. Let's build it out. Now let's build the full picture, because the SGE premium does not exist in isolation. COMEX registered silver inventory, the only metal deliverable against a futures contract, stands at approximately 76 to 79 million ounces per Blowfin Research and Investor Ideas, citing CME Group warehouse data from late March 2026. Investor Ideas reports the drain rate at approximately 22 to 23 million ounces per month. At that pace, 3 to 4 months of registered stock remain before emergency eligible to registered conversions are required at scale. The Silver Institute, per Investor Ideas and Bloomberg, projects a 6th consecutive annual silver supply deficit for 2026, 67 million ounces. The May 2026 COMEX contract has 48,270 contracts outstanding, 241.8 million ounces, with first notice day fewer than 9 business days away, per GoldSilver.ai. That is 241 million ounces of paper obligation against 76 million ounces of real deliverable metal. The rate of depletion is not slowing, it is compounding. The data is doing the talking. The ones who were told the vault drain was overstated, they are not saying much right now. And here is what makes that picture even harder to ignore. Gold is telling the same structural story from the sovereign side. Light Finance reports that China has continued expanding its gold reserves through early 2026, with Malaysia, South Korea, and Uzbekistan also resuming or increasing central bank accumulation. The SGE gold benchmark reflects price-insensitive sovereign demand, buyers who do not sell on margin calls, do not roll futures, and do not respond to short-term volatility. At the same time, the DXY sits at 98.10 per investing.com at multi-week lows. A softer dollar makes Asian physical buyers relatively cheaper acquirers of dollar-priced metals, compounding the SGE premium dynamic. That is not a coincidence. That is a pattern. That is the setup. And before anyone takes that as immediate confirmation of a breakout, setups can take months to resolve fully. The structural picture and the timing are completely separate questions. Anyone who claims to know the exact timing is selling something. Now the Iran variable, because this is no longer a backdrop, it is the primary variable. Here is the number most people are not running: 21 million barrels per day through the Strait of Hormuz, per the U.S. Energy Information Administration. Right now, that strait operates under a dual blockade, conditional access only, with vessels required to use a coordinated route per Iran's maritime authorities, as reported by Trading Economics and Reuters. The 10-day ceasefire is in place as of Friday, April 17th. U.S. President Trump has confirmed publicly, per investing.com, the U.S. naval blockade remains in full force until a comprehensive deal is reached. Oil crashed more than 10% on Friday on ceasefire optimism, per Trading Economics. Treasury yields eased through the week on reduced inflation expectations, per Trading Economics. But the strait has not fully reopened. The IMF, per Trading Economics, has warned that restoring disrupted oil output could take up to 2 years, even after a resolution. Markets are still pricing a clean, durable deal. Look at where oil ended the week, down over 10%. And tell me what probability you assign to that assumption, holding across a weekend with no live pricing. When markets begin pricing a partial or failed resolution, gold reprices higher, silver reprices higher, dollar reprices as safe haven inflows return. That is the historical pattern. Every time a fragile ceasefire has failed to hold under active blockade conditions, it has not been different yet. Gold Western Spot at $4,130 per investing.com. Gold intraday high Friday, $4,189. Silver Western Spot at $81.18 per investing.com. Shanghai SGE silver equivalent, approximately $82 to $83 per metalcharts.org and GoldSilver.ai. A live 150 to 250 physical premium. The short-term read is this: if the DXY holds below 98 and the ceasefire holds into Monday, gold has a technical path toward $4,189 and silver retests $83 to $85 at the Asian Open. If a weekend diplomatic development breaks negatively, either a Strait incident, a failed negotiation, or a U.S. escalation signal, gold gaps toward 4,900 plus and silver spikes before retracing. If a comprehensive Iran deal is confirmed over the weekend, DXY rebounds above 100, gold pulls back toward $4,650, silver retests $74. That is the only short-term framework that matters right now. As for trading the Monday gap specifically, I cannot see a clean picture on the lower time frames. I cannot tell you what gold does at 9 p.m. Sunday when Tokyo opens. Nobody can. If you think you can, good for you. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. A comprehensive Iran resolution removes the geopolitical bid. DXY rebounds above 100 and both metals reprice lower simultaneously. The Fed holds rates at 3.50 to 3.75%, with zero probability of an April cut per CME FedWatch, raising the opportunity cost of holding non-yielding metals. March U.S. CPI came in at 3.3% annualized per Trading Economics, the highest since May 2024, keeping monetary conditions restrictive and capping upside. The bull case is equally real. COMEX registered silver sits at a 13.4% coverage ratio, below the 15% stress threshold flagged by Blowfin Research, with first notice day fewer than 9 business days away. The SGE is paying a persistent 150 to 250 physical premium above COMEX spot, per GoldSilver.ai and metalcharts.org. A premium that historically resolves through COMEX catch-up, not SGE compression. Central bank gold accumulation from China, Malaysia, South Korea, and Uzbekistan, per Light Finance, creates a sovereign demand floor that speculative selling cannot sustainably breach. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. The SGE premium is the clearest data point in this entire picture. It means the world's largest physical exchange disagrees with the COMEX paper price in real time and is willing to pay more for actual metal to prove it. That divergence has one historical resolution direction. Don't take my word for it. Verify every number I gave you today. Check the Shanghai Gold Exchange benchmark data at en.sge.com.cn. Check CME Group official warehouse stocks at cmegroup.com. Check Silver Institute supply and demand data at silverinstitute.org. Logic over hype. Always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0. Out.